Welcome to Pumped On Properties October market update. So much going on, bro, in the last month. Particularly for me, I've been in Bali surfing, it's been sick. But data-wise, this is action-packed, this video. This is going to be an absolute little source of gold. We're talking CBA, CoreLogic, Reserve Bank, Fed Bank, Phil Anderson. It'll be a nice, short, sharp one today, but definitely get your little fix. Can't wait to catch up with you guys soon. Sweet, bro. So let's go to Old Faithful first. CoreLogic. Absolutely love these guys. Thank you so much, Tim, for all the work you guys do. What are they saying this month?
Yeah, look, a lot of information coming out. These guys are great, some amazing articles. If you're not already subscribed, I definitely recommend going over to their page and getting those emails. It just gives you a little bit of a source of truth, right? You know, they're non-biased, they just look at the data. So let's get cracking and start looking at some of these monthly indices. Now, Sydney over the month is down 1.8%. So continuing to decline. Year on year, it's down about 6% at the moment. So nothing crazy, but still seeing some pretty decent declines there. Melbourne, similar story, down 1.1% over the month, but down 3.9% over the year at this point in time. So getting close to that 4% decline at this point. Brisbane had a rough September, going down about 1.7%, but things are still looking positive for people that got in, because the year-on-year returns are still up 13.4% in Brisbane, so things still looking good. Adelaide tracking relatively flat at 0.2% growth this month, up 19% over the year at this point. So Adelaide looking quite good, and then Perth recording a decline of 0.4% in September, up 4.1%. So what they indicate is the rate of decline nationally is actually slowing. So no clear signs of a recovery at this point in time, but some positive signs that we're not seeing as big a declines. And maybe that's got to do with the changes that the RBA made to the cash rate.
You know, I've been saying this for the last 4 or 5 months, man, and on camera in these updates, I believe right now, as of October, you can get a property 10% below market value in Brisbane, Sydney, Melbourne. And in Sydney and Melbourne, you might even be able to get one for 12 to 15% below market value. So for those of you, again, that can confront the fear, that realise this is part of a long-term cycle and realise that buying property is a 15 to 30-year hold to set you and your kids up, it is fucking buying season. It is, with the rate of decline starting to slow and many other indicators that we follow starting to turn confidence-wise, this discount isn't going to be around for much longer. I've talked to a couple of clients recently that work in the major banks, one yesterday who trades markets for ANZ, and he's starting to notice many turns. He's actually saying that their internal forecast is the turn will be around about next March. Mine is around about next July at the moment for the average punter to feel good. You don't want to wait for 200,000 people on the sidelines to come back in. No,
remember 2020, right? Consumer confidence was down massively the whole entire year, but the best buys were found before October.
Yeah.
Now, there's some really interesting information about the rental market. A lot of changes have occurred over the last month, especially up here in Queensland, them trying to support the rental market, because looking at these numbers, it is pretty wild, the increases that we're seeing out there. And it's very challenging for Australian households that are renting at the moment, because the national average is up 10% year on year to September. So rents have increased 10% nationwide. Brisbane has had the strongest rental growth over that 12-month period. The supply side of the rental market is sitting 35% below the 5-year average at the moment. So there is stuff all properties available on the market. And this is because a lot of the immigrants are coming back to Australia. A lot of tourism is picking back up. They're filling a lot of the inner city rental markets that were available, and it's continuing to decline those rental vacancy rates, which is sitting at 1.1% now in September, which is the lowest vacancy rate in recorded history at this point.
I've never seen it below 2% Australia-wide personally as an investor in 13 years. This is significant, and this is going to create a lot of knock-on effects that are very positive for investors and very negative for the average person renting down the line.
Yeah, that's right. And, I guess one of the good things that we can talk about is the change that the Queensland government has now made. Now, prior to the 26th of September 2022, you could only rent out granny flats in certain pockets, certain councils within the Brisbane or the Greater Brisbane region. And you also have some hoops that you have to jump through with how to build that granny flat. But Palaszczuk's actually scrapped that now, and she'll enable people to build and rent out granny flats completely separate to create more rental demand, to create more rental supply, and more affordable rental accommodation as well. So that's a major change that's happened, and really good for investors. You can actually increase your cash flow massively, get a second source of income from that property, or if you've already got one, might make it even easier.
She's moved to the New South Wales model, which is effectively you can now build and rent a granny flat out to a separate, unrelated party anywhere in Queensland. Now, this is just a 3-year trial pilot project at the moment. We're not sure if it's going to work out or if they're going to do something. We've spoken to planning solicitors and town planners, and they have sort of said quite confidently that in Queensland planning law, if you are to build it before any changes are made in the next 3 years, then you'll be grandfathered under planning law in Queensland and you should be looked after for the rest of your life. And for me personally, this is very exciting because there's Gold Coast now that you can build and rent a granny flat on. That is insane. Sunshine Coast, Brisbane City, Redland Bay in South Brizzy, Logan, Ipswich, Moreton Bay in North Brisbane. What I will say is, unfortunately, there's not one statewide position on this is what it looks like there is in New South Wales. There's all of the different councils with all of their different rules. So make sure if you're going to do something like this, you absolutely go talk to the town planner, solicitors, builders, and make sure you're doing the right thing and it complies with what that needs to look like in the future. But a big deal, like in Logan at the moment, we're seeing granny flats rent for $360 to $450 a week for something that costs less than 200 grand to create. This is a phenomenal opportunity cash flow wise for investors.
I would assume Brisbane City Council and Moreton Bay Regional Council, you might be able to get even more than that as well. So we'll have to wait and see because we've never been able to rent one out in granny flats, a granny flat out separately in BCC, unfortunately. The cool thing is with SQM is we're finally starting to see listings increase. New listings are up 3.8% over the month, which is really good. The other thing is average days on market are increasing as well at the moment. So some of those older listings are increasing as well, which is perfect for the buyers. As we all know, 2021, there was nowhere near enough supply for the demand. Now we're starting to see a little bit more of an equilibrium, which is great. Now, the other huge change that has come out, obviously, Palaszczuk came out and said that she was going to make some significant changes to the Queensland land tax laws. Now, she's actually reversed her position at this point in time on those changes, which is great. There was a lot of people that were quite fearful of those changes. I know a lot of people were reaching out and asking me questions about how this will impact their situation. So good news, keep a little bit of cash flow in the pocket for those investors.
Land tax, no change, exactly the same as it was. It was just the government trying to triple, quadruple, 10 times dip on property again. And the naughty property investors up here in Queensland that are the actual ones supplying all of the rental property for all of the 1,000 people a week moving up at the moment. I think she realised that she was going to get kicked out, to say the absolute least, in Queensland, so it's been scrapped. No stress. Another example of all of the flexing politically, but at the end of the day, almost every politician on either side of the government owns between 2 and 5 investment properties themselves. The banks in Australia aren't like the banks in the rest of the world that are diversified. Most of the banks' balance sheets in Australia are 50 to 60, maybe even 70% leveraged on Australian property. It is just one of those things where it's a double-edged sword. We need a correction and we'll get one at some point in the next 10 years, but no one wants to be the catalyst for that correction. And they're not going to let interest rates go too far to the point where people are defaulting on their loans. Those rates, according to the Reserve Bank, should come down, and they should come down quite quickly in the next 2 years again.
One of the funny things that I read was a Michael Matusik article where he was just having a bit of a rant about Palaszczuk and the changes and things like that.
He would have been into her, eh?
Oh, he was. But he actually ran the numbers of what the changes would do. And, one of the things that he believes is she realised that it actually wasn't going to make much more money for the actual government. So, that was one of the big reasons. But look, change is the only constant, right? It is good to experience times like this. You know, over the last 5 years, we've experienced so much change in the Australian economy with the Royal Banking Commission and APRA, and then having COVID and the lockdowns, and, you know, having the interest rates decline and then rise again, and seeing vacancy rates go up and then back down again, seeing land tax laws change, granny flat laws change. It is just, this is investing, and you really need a thick stomach to be able to handle a lot of these changes, which is why a lot of people shy away from it. But, you know, 5 years of a lot of change, it really helps you see how this industry works.
Unreal. Like, there was a quote, unreal, what am I saying? I don't even know what I'm saying here. There was a quote yesterday that one of the clients that I spoke to, who was just getting started, gave me from Robert Kiyosaki, and he said, the only difference between a poor person and a wealthy person is their ability to manage and tolerate risk.
Yeah.
And like, it really resonated with me, because I'm always thinking, like, what is stopping the average person earning 80 grand or 200 grand as a household from slowly saving some money, buying a property that covers its own costs, and then sitting on it for the next 30 years and completely changing their stars? And I'm like, it's the ability to handle that uncomfortableness. If you're getting blown around by the wind over the last 5 years, you've missed 60% growth in Sydney, Wollongong, 100% growth in the Gold Coast, you know, 100% growth in the Sunshine Coast in some suburbs, 30% growth in some Brisbane areas. You know, like, there's been such a big opportunity for the fear. And the only thing that the media really wants to do is scare the shit out of us. And I think they're getting to the end of, like I said they would by the end of the year, the property fear working. People are kind of going, that's cool for you guys, but like for me, I do want a property that potentially can double in value in the next 15 to 25 years.
Absolutely.
And I've got this money sitting in the bank, because that's the next thing you'll talk about. Savings rates are still going up.
Yeah.
Incomes are still going up according to CBA, and people are sitting on an unprecedented amount of cash, which will end up back in the markets in the future.
Absolutely. So we'll continue on and start talking about some of the things that have occurred with the RBA. Obviously, October 4th, my 30th birthday, we had a 25 basis point rise. I got handed another letter from Resimac, one of my lenders, with an increased rate. Great birthday present, right?
Here's $2,000 a month, Fred.
Although I did call them up and said, hey, this ain't on, and they actually reduced it down to 4.9%. So I was like, okay, happy days.
4.9.
Yeah, 4.9 P&I on that one. But look, up 25 basis points, that brings the cash rate right now to 2.6%. Inflation, the expectation for 2022 is to see inflation up 7.75% in 2022. So pretty significant, but at least it's not as bad as some of the other Western countries around the world. They expect it to really come down next year to 4%, which isn't as bad as what they were expecting, and then 2024 back to the target inflation rate of 3%.
You know, I saw an inflation figure that they were forecasting at the start of last year, and they were saying 1.5 to 2%.
Yeah.
So none of us have an idea, and the sooner you realise that, like the RBA, CBA, us, Phil Anderson, like, no one has a crystal ball, and everyone's just reactively making the best decision they can, the sooner you can realise that, like, this will continue indefinitely forever while we've got this monetary system.
Exactly. It's good to go into these market updates and actually look at the data that we've seen from the month before as well, because like, we can talk about the future, which is not promised for anyone, but this is real data. This is real indicators, and over time you can actually put the piece of the puzzle together. But the unemployment rate is at the lowest rate that it's been in over 50 years now, sitting at 3.5%. Now, job vacancies and ads are up, indicating that unemployment will continue to decline over the next few months as well. So, you know, really good. If you want a job, you can easily go and get a job at the moment. If you want extra hours, you can easily go and get extra hours at the moment, which is great. But the reaction to that is, you know, increased savings. People are spending a bit of money on discretionary things, and that is obviously helping, well, not helping, but it is causing even more inflation there. Look, higher inflation and higher interest rates is putting more pressure on household budgets, but with the low unemployment rate and wages increasing, household savings rate is still higher compared to the pre-pandemic levels. So people are still moving in a positive direction, even with higher interest rates on their mortgages, even with the cost of living going up at the moment, which is a really good thing to see.
You know, I've been talking to many, many friends about this, and everyone's tightening the belts at the moment, myself included. Like, I've been looking at expenses and cancelling some subscriptions and looking at some discretionary stuff as well, and just like keeping a little bit more of a lid on it. Like, I hope that, you know, that's what's happening.
Might I say though, weren't you saying you're going to go buy 2 new surfboards?
Yeah, but I've got to sell my 2 other surfboards because they got wrecked in Bali.
Yeah, you know, it's funny, like people are still spending money.
People are still spending cash.
Yeah, but the other thing with CBA, like obviously 25 basis point rise in November, up 250 basis points since May. Now they expect the cash rate to go up another 0.25% in November, and that will bring the cash rate to 3.1, where they have indicated that they expect it to sit there for a period of time. Very vague, but we'll wait and see how long they hold it there for, or if they do hold it there.
What they're saying is if this is working, then we'll hold it. If this is working really, really well, we'll keep it there and then we'll cut it next year. If this isn't working like it's not in America right now, then we're going to increase it further. And, you know, that's okay, because most people who got home loans since the changes in 2015 with APRA have actually been like their forecast servicing level was more like 6.5% to 7%. So for many people, the banks have already wrote that buffer in. I'm hoping that we don't see interest rates at 6 or 7% yet at this stage in the cycle, because that will cause a lot of pressure on many people's households.
And we've been saying this for a while. It is really up to the RBA as to what's going to happen next. If they keep pushing, it's going to be hard for a lot of people. If they keep it steady, then we might be all right, but we'll wait and see. Now, the last thing, Phil Anderson, over the last month, with a lot of the news coming out around the world, some of the changes that have been happening in the UK, in the US, in Australia, they 100% truly believe that the cycle is still on track. You know, they indicate that the Fed is always behind the curve, and they went into some history and started looking at previous times where we've been at this stage of the real estate cycle, in the second half of the real estate cycle, which is where things are a lot more volatile, a lot more emotional, and a lot more bumpy. And 2022 has been relatively normal for where we are in the cycle. Now, he went back to 2002. And at that point in time, the media cycle was even worse. Consumer sentiment was even worse than it is today. Obviously, we had the war on terrorism, America invading Afghanistan. And
September 11 was only the year before.
Exactly. Like all of these crazy things were happening back then as well. So, you know, what they say is nothing new. There's nothing new under the sun. You know, everything has happened before, and this is just a recreation of to what's happened in the past. And whilst it still is highly emotional and a bit more of a volatile period, we are still on track for what these guys are anticipating at end of this cycle, or top of this cycle, around 2026 or 2027. So they do predict that we've got some positive years in front of us as well.
You know, when we caught up with Phil recently at his event, and then for dinner after, I asked him a whole bunch of like just questions that I probably shouldn't, but I know he loves it as much as I do, so thank you, Phil, always. But his rationale for why we are not at the top yet, and a lot of other people aren't looking at this stuff, is, you know, interest rates are relatively low and they haven't stepped up really, really aggressively in many parts of the world. We've still got access to credit at the moment. The banks are still more than happy to lend. A lot of countries around the world, Europe, America, Australia, have seen pretty significant gains in some of the bigger cities. And so a lot of people borrowed money at 500K, for example. Their property is now worth $1 million, and a lot of people are sitting on big equity. Now, a lot of that equity hasn't come back into the market yet. People aren't out there over leveraging themselves at the moment in a lot of instances around the world. There's massive, massive, massive amounts of corporate money as well as personal money sitting in bank accounts around the world that hasn't gone into crypto again yet, that hasn't gone into stock markets or bond markets yet, that hasn't gone into property markets. We get closer to the top of the cycle when the governments are like, banks, everyone's got equity, which is what's coming in the next 1 to 2 years. Just go feral for a few years because we put the handbrake on in the mid-cycle slowdown. And so there is much, much more to come. There is much more speculation. not many people are talking about property around the world in a positive way at the moment. By the top of the cycle, every single man and his dog, the hairdresser, the baker, the guy at Boost Juice will be all in again, borrowing money, leveraging money, and that will be the time when we can come into trouble. That will be when stock markets have been running for years in a row and people like this is never going to end, and that is when we hit the pain point. That's when interest rates really do go through the roof. That's when banks stop being your friend and play hardball, and that's when you want to protect yourself.
Yeah, so I hope that unfolds. You know, we'll have to wait and see. A fair few years of history to suggest that could be the case. But, you know, in my opinion, looking at some of this information, we've got, you know, two sides of the coin, right? We've got some really positive news out there. We've got some relatively negative news out there. And, you know, this is the world that we live in. There's always going to be a balance between those two things. But, you know, for me, I'm still quite bullish about the long-term future and excited about what's to come, and, you know, really grateful for the people that we're working with at the moment, the deals we're able to secure from some of the agents. So, yeah, we'll keep bringing these market updates on a monthly basis for everyone. If you could please share this with a friend that needs to listen to this to get a little bit of an update. But most importantly, please like the video. Please subscribe to our YouTube channel so we can continue bringing this information and growing this channel to bring you good information.
Woo!
That's a wrap.
That's a wrap.
Cool, bro. Yeah. Oh, sweaty. So sweaty. Oh, that's good. Look at that.
So nice, eh?
Oh.